Most options education tells you that long calls profit when the stock goes up. I want to show you a case where that's exactly wrong. You buy a 5% out of the money call, stock at 100, strike 105, 5 days to expiration, going into earnings. The call costs you $2.20. The implied volatility is at 75%. High, because earnings are coming. You are paying for the uncertainty. Earnings releases. The stock rallies 4% to 104. You were right. Direction was your way. But your call? It's worth 70 cents. You lost 68% on a winning move. Here is why. The two Greeks fought each other. Delta gave you back $1.20. Stock went to 104, basically up $4. Your delta was 0.3. The math, 4 into 0.3, which is $1.20 per share. But Vega took $2.70. IV crushed from 75% down to 30%. The math, 45 IV points multiplied by your Vega, which was 0.06, and that translates to a $2.70 loss. Vega's loss was over double Delta's gain. Net minus $1.50 per share, $150 per contract. Vega ate Delta's lunch. Long premium into earnings needs a bigger move than the crowd already priced in. The market expected this volatility. That's what the 75% IV was telling you. You needed the stock to clear $107.20 just to break even at expiration. You got 104. Right direction, wrong magnitude. The rule: size small into earnings. Respect Vega. Stop paying the tuition.